You know, most traders don't lose their money because of bad markets. They lose it because of something quieter, something that eats away at their balance while they think they're being careful. That's what I call the silent mistake. And if you've been trading for any length of time, you've probably made it without realizing it. In fact, it's the very thing that separates the professionals from the public. And before we dig in, remember, this builds right off what we talked about in the previous video on how to sharpen your trading edge. Because once you have that edge, the real test isn't finding trades, it's keeping your profits from leaking away. Now, let's be honest for a moment. How many times have you watched a small gain turn into a loss because you didn't want to sell too early? You tell yourself you'll give it a little more room, that the stock will come back, that you'll ride the trend. And then suddenly, you're staring at your screen wondering how something that looked so promising has turned against you. That's not bad luck. That's hesitation, the quiet killer of trading accounts. You see, the market doesn't shout when it's about to change direction. It whispers, it hints, a shift in volume, a hesitation in price, a failure to make a new high. And yet, most traders ignore those whispers because they're emotionally invested in being right. They cling to the idea instead of the evidence. Tell me, haven't you ever felt the tug to hold on just a little longer, even when the chart's telling you otherwise? When I was trading in the old bucket shops, I learned early that the market doesn't pay for opinions. It pays for discipline. Every dollar I lost was a tuition fee to that lesson. I'd watch other traders blow up their accounts, not because they couldn't pick a direction, but because they couldn't let go of a mistake soon enough. The silent mistake isn't about entering wrong, it's about staying wrong. You can study all the chart patterns in the world, memorize every moving average, every breakout signal. But if you don't know when to stop listening to hope and start listening to price, you'll drain your account little by little. The market doesn't need to crash to hurt you. A slow leak is enough, and that slow leak is often pride disguised as patience. Let me tell you something most traders won't admit. The hardest decision isn't when to buy. It's when to sell. You can't rely on excitement or fear to guide you, because both lie. You must rely on observation. You must train your eyes to read the tape the way a hunter reads tracks in the dirt. Every hesitation in price, every failure to follow through, it's telling you something. Do you listen, or do you wait for the market to confirm what you hope it will say? In the last video, we talked about sharpening your trading edge, your ability to see clearly when others are confused. But an edge is useless if you dull it with indecision. Think about that. You spend weeks refining your setup, your entry criteria, your risk management, and then you give it all back because you hesitate to act on what your edge tells you. The silent mistake isn't just emotional, it's habitual. Here's the truth most don't want to hear: the market rewards decisiveness and punishes hesitation. Every tick that goes against you tests your resolve. Every candle that hesitates tests your discipline. The moment you start to question your plan, you've already started losing. Not money yet, but focus. And that loss of focus always precedes the loss of capital. Ask yourself, how many times have you moved a stop loss just because you didn't want to be wrong? You think you're giving the trade little more room, but what you're really doing is giving your ego more rope. And that rope only pulls tighter the longer you hold. A trader who can't take a small loss will eventually take a large one. That's the silent mistake, the refusal to take a controlled loss while you still can. You have to understand, the market is a machine built to test conviction. It doesn't care about your comfort, your confidence, or your predictions. It cares about one thing: execution. You can't talk your way out of a bad trade. You can only act. You either take the loss, or it takes you. I've watched fortunes disappear not in crashes, but in the slow erosion of small, stubborn losses that were never cut. A lot of traders chase the thrill of being right. But trading isn't about being right. It's about making money. There's a difference. You can be wrong half the time and still come out ahead if you manage your risk. But if you let pride cloud your judgment, Even one wrong position can undo months of good work. The silent mistake whispers, "Just wait. It'll turn around." And that whisper has ruined more traders than any market crash. Remember what I said about the edge. Your edge is only as sharp as your discipline. When you fail to act on your rules, you dull that edge. You make it harder to cut through noise, harder to see truth in price action. The mistake isn't just emotional, it's technical. It seeps into your execution, your timing, your reading of the tape. You start seeing what you want instead of what's there. That's when the market starts taking back everything it gave you. You can't afford to treat your capital like an emotional comfort blanket. Every dollar in your account is a tool, not a trophy. You must protect it with the same seriousness you'd guard your livelihood, because that's exactly what it is. When you let small losses linger, you're not being patient, you're being careless. Patience belongs with winners, not losers. Tell me, when was the last time you closed a losing position and felt relief instead of regret? That feeling of clarity after cutting a loss, that's the real high of trading. It's the quiet confidence of knowing you acted on reason, not emotion. That's where consistency begins. Because in this game, survival comes before success. You can't grow an account that's bleeding slowly every day. Every trader must eventually face this truth. The silent mistake isn't in the market. It's in ourselves. It's the reluctance to admit we're wrong, the temptation to adjust rules on the fly, the comfort of denial, and the market, patient as it is, will always collect its due, sometimes quickly, sometimes quietly, but always eventually. You can have the best system, the sharpest strategy, the most refined chart, reading skill, but until you learn to stop the leaks, you'll never build lasting wealth. That's the part nobody wants to talk about, because fixing it isn't exciting. It doesn't sell books or courses. It's quiet work. It's the daily discipline of closing the screen when you should, of not trading out of boredom, of respecting the chart instead of fighting it. And that, my friend, is where most traders lose. Not in the chaos of volatility, but in the silence between decisions, in the hesitation between signal and action. The silent mistake isn't in the chart, it's in the trader's mindset. That's where it all begins and where it all ends. Most traders spend years trying to find the perfect setup, the flawless indicator, the secret combination of signals that will make them rich. They look at the chart as if it holds all the answers. But the truth is, the chart only reflects what the trader brings to it. It's a mirror, not a map. You can't see clearly in the market until you've learned to see clearly within yourself. You can give two traders the same chart, the same information, the same tools, and they'll make opposite decisions. One sees opportunity, the other sees danger. One sees confirmation, the other sees uncertainty. The difference isn't the data, it's the interpretation. And interpretation is shaped by mindset. Tell me, haven't you ever looked at a chart and seen exactly what you wanted to see? A setup that wasn't quite right, but you convinced yourself it was close enough. That's the mind distorting the message. When you sit in front of the market, you're not really battling price or volume. You're battling yourself, your impatience, your fear, your greed, your need to be right. Every trade is a test of who you are under pressure. The chart is neutral, your reaction is not. The silent mistake happens when you think the problem lies outside of you, when you blame the market for doing what it always does move. The real problem is how you interpret that movement. Most traders don't realize how much their own psychology leaks into their analysis. They start seeing patterns that aren't there because they want them to be there. They hold on to losing trades because they hope the market will turn. Hope and fear are powerful forces, but they don't belong on a chart. The market doesn't know what you need or want. It only reflects balance and imbalance between buyers and sellers. Yet traders project their emotions onto it like a screen. That's the silent mistake. It's internal, not external. Every professional trader I've ever known learned this the hard way. They went through a period where they thought knowledge was the answer. They read every book, studied every indicator, learned every formation. But no amount of knowledge fixed the emotional side of trading. Because trading isn't just an intellectual pursuit. It's an emotional battlefield. You can know exactly what to do and still fail to do it. How many times have you watched a trade move against you and refused to cut it, even though your plan told you to? That's not a technical error. That's a mental one. Your mindset determines your execution. If you approach the market with fear, you'll see threats in every move. If you approach it with greed, you'll see opportunity where there is none. The trick is to approach it with neutrality, with observation, not attachment. But neutrality doesn't come naturally. It must be trained. You have to teach yourself to detach from the outcome, to trade the process instead of the profit. That's where consistency begins. Think about how you react to losses. Do they make you angry, or do they teach you? Every loss is a message from the market, but you can only hear it if you're calm enough to listen. Most traders react instead of respond. They revenge trade, they double down, they abandon their plan. Not because the strategy failed, but because the mindset cracked under pressure. The chart didn't change, the trader did. That's how the silent mistake sneaks in. In trading, patience is more valuable than prediction. The market rewards those who can wait and punishes those who can't. Yet most traders can't stand silence. They feel the need to act, to trade, to be in motion. But the best traders know that the real skill is in doing nothing when there's nothing to do. Impulsive trading is a symptom of a restless mind, a mind that seeks validation through action instead of accuracy. That restlessness drains accounts faster than any bad strategy ever could. Confidence in trading doesn't come from winning trades, it comes from following your rules. Because you know as well as I do, winning a bad trade by luck teaches you the wrong lesson. It feeds the ego. It convinces you that discipline can be bent. But every time you break your rules and get away with it, you reinforce the mindset that destroys traders in the long run. The silent mistake begins with those little compromises, the ones that feel harmless at the time. A professional trader's real work isn't in finding trades, it's in maintaining clarity, emotional clarity, mental clarity. When you're clear, the market's noise fades and the truth of the price action stands out. When you're not, everything looks like a signal. You start reacting to shadows instead of structure. That's how good traders slowly lose touch with their own system. They stop trusting their process because they no longer trust themselves. When the chart and your emotions start to merge, you lose perspective. You start thinking of profits as validation, losses as personal failures. But the market isn't judging you. It's testing you. Every fluctuation is a chance to see how well you can follow your own plan. Can you stay objective when your equity curve dips? Can you stay humble when it spikes? Those are mindset questions, not technical ones. It's easy to blame volatility, manipulation, algorithms, whatever excuse fits the moment. But the truth is, the market has always been uncertain. The difference between a trader who survives and one who fades away is psychological resilience. The ability to take a loss without losing confidence, to take a win without becoming careless, to stay centered while the crowd panics or celebrates. That's mindset mastery, and that's what prevents the silent mistake from taking root. And yet, every day, thousands of traders sit down, stare at their charts, and repeat the same emotional cycle. Fear, hope, hesitation, regret. Over and over. Not because they lack skill, but because they haven't yet realized that their worst enemy isn't volatility, it's inconsistency. Inconsistent thinking, inconsistent execution, inconsistent self-control. You can't fix that with a better setup. You fix it by changing how you think about trading itself. The silent mistake that drains accounts doesn't announce itself with a big loss. It starts small, with a little impatience here, a little overconfidence there. It's invisible at first, but it grows stronger every time you ignore it. Small, ignored losses grow into account, draining mistakes. That's how most traders fall, not through dramatic crashes, but through quiet erosion. You see, the market rarely takes everything at once. It nibbles. It takes a little here, a little there, and before you know it, the balance that once looked strong has thinned down to something fragile. And the cruel part is, the trader often doesn't even notice until it's too late. The danger isn't in the loss itself, It's in ignoring it. Every trader knows the feeling. You take a small hit, and you tell yourself it's nothing, just a normal pullback. You think, it'll come back. Maybe it does once or twice, and that convinces you that holding through pain is the right thing to do. But one day, the market doesn't come back. One day that small loss grows teeth, and you watch your position bleed while you wait for a miracle. That's when you realize the most dangerous losses are the ones you refuse to take when they're small. Tell me, haven't you ever stared at a red position and thought, just a little longer? The small loss is a gift. It's the market's way of telling you, something isn't working here. But instead of listening, traders try to argue. They move stops, justify entries, or blame volatility. The truth is, the market doesn't care. It's not personal. A loss is feedback. Ignoring that feedback is like covering your dashboard light with tape while the engine overheats. The warning doesn't go away. You just stop seeing it. In my early trading days, I made the same mistake everyone makes. I thought patience meant holding through pain. I believed that good trades always turned around if I gave them enough room. But the market doesn't reward hope. It rewards timing. When a trade goes against you, it's not a sign of failure. It's a signal that something's changed. Maybe the setup's invalidated. Maybe the momentum's shifted. Maybe your read was wrong. Whatever the reason, the job of a trader isn't to defend a position. It's to protect capital. Think about how easy it is to rationalize a small loss. It's only down 2%. You say, I'll add a little more to lower my average. That's how it starts. You turn a controlled loss into an emotional one. You start trading to fix the mistake instead of trading to make good decisions. The moment you start thinking about getting back what you lost, you've stopped trading the market and started trading your emotions. And the market always wins that fight. Cutting losses early isn't about pessimism. It's about survival. Every professional trader knows that the first rule is preservation. You can always re-enter. You can always make another trade. But you can't rebuild discipline once you break it. A trader who refuses to take small losses soon learns what a big one feels like. The silent bleed of ignored losses doesn't just drain your account. It drains your confidence. And when confidence goes, decision-making follows. A loss accepted early is a position of strength. It says you trust your plan more than your pride. It means you've learned to separate being wrong from being foolish. There's nothing wrong with being wrong. Every trader is. But there's everything wrong with refusing to admit it. The longer you let a loss linger, the more emotional it becomes. You stop looking at price action and start looking for comfort. You seek confirmation, read opinions, watch other traders' charts, anything to convince yourself you're not wrong. That's the trap. The traders who survive decades in this business all share one trait. They're ruthless with small losses. They know a trading account is like a ship. A big storm can sink it, sure, but so can a slow leak. If you patch the leaks early, you'll weather anything. But if you ignore them, even calm seas will drown you. That's why they never let a trade wander too far from their stop. They treat each small loss like a toll paid for staying in the game. Because that's what it is. A cost of doing business, not a punishment. You can't control what the market does, but you can control when you exit. And that control is your lifeline. Every time you cut a loss small, you buy yourself time and emotional clarity. You free your mind to spot the next opportunity instead of obsessing over the last one. The trader who refuses to take small losses ties up capital and focus in the past, while the next trade moves on without them. That's how opportunity cost compounds quietly, side by side with financial loss. In the previous video, How to Sharpen Your Trading Edge, we talked about clarity, seeing the market for what it is, not what you wish it to be. This ties directly into that. Because when you ignore small losses, you're not seeing clearly anymore. You're letting emotion cloud your edge. You might have the best setup in the world, but if you can't act on it objectively, if you're weighed down by yesterday's mistake, your edge dulls. Discipline and objectivity are what keep your edge sharp, and ignoring losses corrodes both. Traders like to say, Let your winners run and cut your losers short. Everyone repeats it, but few truly live it. The reason is simple. It's uncomfortable. It takes emotional control to sell something at a loss. The ego hates it. The ego whispers, "Wait, it'll turn around." And sometimes it does, just enough to reinforce the bad behavior. That's why the silent mistake keeps repeating. It rewards disobedience just often enough to keep traders hooked. But here's the truth. A trader's real progress isn't measured in profits. It's measured in how quickly they recognize and correct errors. The speed at which you accept a small loss determines the size of your future success. Every small, disciplined loss is a reminder that you're operating from strength, not emotion. Each one keeps your account healthy, your focus intact, and your judgment sharp. Ignoring a small loss is like ignoring friction on a machine. It doesn't break right away, but the wear builds up until the system fails. Your trading psychology works the same way. Every time you avoid responsibility for a loss, you weaken your internal structure. You start doubting yourself, adjusting your plan on the fly, and losing faith in your system. By the time the big loss comes, it's not a surprise, it's a result. Most traders believe that big failures come from big mistakes, but that's rarely true. Big failures are the sum of many small mistakes ignored along the way. Each one feels too minor to matter until they all add up. And when they do, the trader calls it bad luck. But it wasn't luck, it was neglect. A lack of attention, a lack of discipline, a lack of respect for the small things that quietly keep a trader alive. The traders who make it long-term treat every small loss as data. They record it, study it, learn from it. They don't hide from it, because they know every ignored loss is a lesson unpaid. And in trading, unpaid lessons always come due, with interest. Price action whispers before it shouts. Learn to listen. That's the essence of trading, yet it's what most traders fail to do. The market rarely announces its intentions with a loud signal. It moves quietly first, testing the attentive and punishing the impatient. The subtle changes in tempo, the pauses, the failed pushes, those are the whispers. By the time the market shouts, it's too late. The move is already in motion, and the crowd is finally noticing what the tape had been telling you long before. Every chart tells a story, but you have to train your eyes to read it like a language. You can't rush it. The market gives clues the way a good poker player gives away tells, just enough for the sharp observer to notice. A wick that rejects a level, a surge in volume without continuation, a hesitation after a breakout. All of these mean something. Most traders see them but don't understand their weight. They want confirmation, they want certainty, and by the time they get it, the reward is gone. Tell me, haven't you ever waited too long for proof, only to enter right before the reversal? The whispers of price action live in the pauses, not the moves. Everyone can spot a big candle. That's easy. But the real art is seeing why it formed and what happened before it did. When the market pauses after a strong trend, it's asking you a question: continuation or exhaustion. The answer is in the rhythm of price, in the way it behaves around key levels. Are buyers still eager? Are sellers hesitating? The tape always tells the truth, but only to those who listen without bias. When I first learned to trade, I used to chase every big move. I thought the secret was to act fast and ride momentum. But over time, I learned that the big moves don't start loud, they start in silence. The market always builds pressure before release. The patient trader learns to recognize the tightening, that coil of price that signals imbalance. You can feel it, almost like the quiet before a storm. Those who can't hear it end up caught in the wind. You can't hear those whispers if your mind is noisy. That's why emotional control matters as much as technical skill. When you're anxious, greedy, or afraid, you stop reading the market and start projecting onto it. You don't see what's there, you see what you want to see. A trader who listens with emotion hears noise. A trader who listens with discipline hears rhythm. The price always has a rhythm. Faster when the crowd is excited, slower when it's uncertain. Every acceleration or pause is a message. Learning to listen to price action means letting go of your need to predict. You're not trying to tell the market what to do. You're trying to understand what it's already doing. That's the difference between chasing and following. The crowd chases confirmation. The trained trader follows behavior. When volume dries up near resistance, when price starts rejecting support with shorter wicks, when higher highs fail to attract follow-through. That's the market whispering, "I'm losing momentum." The novice ignores it, the professional prepares. Remember what we discussed in How to Sharpen Your Trading Edge. Your edge comes from perception, not prediction. This ties directly into that. When you sharpen your perception, you start seeing what others overlook. You catch the early hints in price before they become obvious. That's what gives you positioning power. The crowd trades the obvious, professionals trade the emerging. The whispers of price are where those emerging shifts begin. But the problem is, most traders want certainty, and certainty doesn't exist in the market. Whispers are uncertain by nature. They're signals of imbalance, not confirmation. That's why listening takes practice. You have to build trust in your own observation, not in someone else's analysis. The more you rely on external voices, the more you drown out the market's own. The price itself is the purest source of truth you'll ever find. It doesn't lie. It doesn't hide. It's just interpreted poorly. You'll notice, when the market transitions from quiet to loud, that most traders enter right when it's shouting. The breakout looks obvious, the news lines up, the chart confirms what they wanted to believe. But by then, the professionals are already taking profits. They listened when it was quiet. They positioned while everyone else was distracted. That's why they seem lucky. It's not luck. It's observation. It's the ability to hear the whisper before the roar. Sometimes the whisper comes in the form of divergence, momentum slowing even as price creeps higher. Sometimes it's in the volume, a drying up of participation at key levels. Sometimes it's in failed reactions, when price should move but doesn't. Each of those moments tells a story. The market is made of people, and people reveal themselves in hesitation. Learn to read that hesitation, and you'll know more than any indicator can show you. Listening to price doesn't mean predicting tops or bottoms. It means noticing behavior. It means seeing when the market is pressing against resistance without conviction, or when buyers are defending support with less enthusiasm. It's about attention, not anticipation. You have to ask, what is the market trying to do, and is it succeeding? That question, more than any pattern or formula, will keep you aligned with truth. The best trades rarely look perfect when they begin. They look uncertain, uncomfortable, even risky. That's because the whispers aren't meant for the crowd. They're meant for the trained observer. By the time everyone agrees, the opportunity's gone. You have to act before consensus forms. And that takes confidence in what you see, not what others say. It's ironic, isn't it? The quieter the signal, the more powerful the move that follows. But most traders can't sit through silence. They want constant action, constant validation. The irony is that the more you chase noise, the less you hear the market's real message. The trader who can sit in silence, who can watch without forcing a trade, becomes attuned to those whispers naturally. The market doesn't hide opportunities, it hides them behind patience. You'll start to notice the subtle changes, the slowing of momentum, the compression of range, the build-up before the break. It's all there, written in price. You just have to be still enough to see it. Price action whispers before it shouts, and if you can hear it early, you won't need to chase the noise later. The whisper is the edge, the shout is the crowd's reaction to it. Your trading edge dies when you ignore your own rules. That's the cold truth most traders don't want to face. You can have the sharpest system, the perfect setup, and years of experience. But the moment you start bending your own rules, that edge begins to rot from the inside out. It doesn't die in one big mistake, it dies in small acts of disobedience. A little compromise here, a small exception there, until your once disciplined method becomes a mess of emotion and improvisation. That's how consistency fades. Every trader starts with rules. You write them down, backtest them, swear by them. You promise yourself that you'll stick to them no matter what. But the first time the market tempts you with a special situation, those promises start to blur. You take a trade that's close enough to your setup, you move a stop just a few ticks wider, you let a loser breathe because it might bounce. And when it doesn't, you blame the market. But the market isn't to blame. You are. Tell me, haven't you ever broken a rule and hoped the market wouldn't notice? The truth is, your rules exist to protect you from yourself. They're not about limiting opportunity. They're about limiting destruction. Every time you ignore one, you weaken your structure. It's like removing the bolts from a bridge. The first few don't matter, but eventually, the whole thing collapses under pressure. Your trading edge is the result of thousands of disciplined actions. Lose the discipline, and the edge disappears no matter how good your analysis is. Most traders believe their edge lies in knowledge, in patterns, setups, or indicators. But that's only part of it. The real edge is consistency. Two traders can trade the same system and get opposite results, because one follows the rules with precision and the other follows emotions. The system doesn't fail. The trader does.